Coming up on the show, we debate bulls and bears with Glenn Silverman from Investment Solutions and Paul Hansen from Stanlib. Remember, you can follow us on Twitter at Investment360. A market trend is the tendency of a financial market to move in a particular direction over time. We get both bull and bear markets. A bull market is associated with increasing investor confidence and increased investing in anticipation of future price increases, and often begins before the general economy shows clear signs of a recovery. A bear market is a general decline in the stock market over a period of time and is a transition from high investor optimism to widespread investor fear and pessimism. Joining us to explore this further is bearish Glenn Silverman from Investment Solutions and bullish Paul Hansen from Stanlib. And the colours, gentlemen?
Yeah.
Why green? Substantiate your green tie on a bull and bear.
It's a bear in the bull market clothing.
Absolutely. That's positive momentum. Have you changed your clothing?
I've got to go buy a red tie. Yeah.
All right, so Glenn, the news flow isn't getting any better. If anything, as I keep saying, it's growing in terms of the drama, and the magnitude of what could go wrong now is really almost unbearable.
So Brownyn, you're wearing white, so you must be in the neutral camp. And
I'm
yet,
so
I'm in
neutral.
blue. I'm in blue.
Purity.
And yet, when I listen to you, I'm glad to hear you've converted, which is excellent. So yes, I think the news continues to get worse, and I think it definitely is broadening. One spoke about Europe, one spoke about the States, but even some of the BRIC countries now, slowdowns in Brazil, troubles in India. So I think it is spreading, and I think some of the ramifications of this are quite significant. So yeah, it's spread.
But you are standing firm, Mr. Hansen. There's not a worry in sight as far as you're concerned.
Oh, no, I didn't say that. I have grey hairs from certain worries. There's always uncertainty. There's an unknown future out there. But the more the pessimism grows, the more the worry grows, the slightly better I feel about the bullishness out there. If you look at for example, Merrill Lynch does a survey of asset managers offshore, and they say right now the bearishness or the feeling down about things is about as bad as it was at the worst last year. If you look at the cash positions, they're holding about 3.5% in cash, asset managers offshore, which is the third highest in history. The other two highest points were just before the bull market started in 2009 and in 2003, before a mighty bull market started. So there's some interesting signs out there that there's so much pessimism building that most of those nervous Nellies like you and Glenn, who would have sold, probably have done so.
When you've got to straddle a very fine line here, you're also net neutral.
These are two ex-work colleagues of mine, so I know them well for many, many years, and I know all of their particular attributes and positive and negative characteristics. So I know them well. Look, you've got to watch out for excesses in investments. You've got to watch out for excess optimism, and you've got to watch out for excess pessimism. The only thing you can hang your hat on is the current valuation of markets. In other words, you can be very pessimistic, but if markets, for argument's sake, are at a 6 PE, you can buy them. You can be very optimistic, but if markets are at an 18 PE, you mustn't buy them. So you can only really evaluate the current level of market valuations, and roughly speaking, our market is definitely not cheap enough to buy. But if you think the world's going to survive, you have to sell out your US long bonds, because that is just taking into account too much bad news.
All right, Paul, jump in here.
I think our resources market is cheap enough to buy. You don't think so?
That's possible, yeah. No, that is true.
Are you afflicted with excess negativity or excess pessimism?
I don't think excessive, just pessimism, just generally. So I think Wayne makes a very good point, and we made that often. You have to look to valuations at the end of the day. The problem is I think they're so obscure. You have no idea what a valuation is. We know that we have record corporate earnings in the States. So we look at an average multiple on record earnings, and I think that's an expensive market, not a cheap market, because I believe that's unsustainable. Now, Paul, I think he's right in saying in the short term, and it's the only thing he's right on, is that
you're close enough to clap him over the ear, you know that.
Is that the markets are very much oversold. I mean, they had a terrible May. In fact, Paul, I got hold of him last week and I said, let's do the show. And he says, just because markets are so bad and I've been so badly gored. So he had been gored. It was a very, very bad period of time. So we have a bit of a rally, but rallies need to be sustainable, and I think they're driven by some sustainable functions. And if it's acronyms, QE or LTROs or twists or untwists or whatever, I find it very hard to believe. I think the efficacy of those measures are largely behind us. I mean, I think it's fascinating. People talk about, is QE3 coming? Now, if the intention of QE1 and QE2 was to try to get the long bond down in America, it succeeded. It's more than succeeded. There's nothing left to go. They might want to get it up now because it's actually talking now to maybe a deflation environment, which is even more worrying. So I think their game's played out, although the market still takes a lot of store of confidence in the Fed and its abilities and the ECB and its
Why haven't we seen these emergency measures yielding fantastic results and we're clearly out of the woods? Because nobody can actually say that.
What? Brownyn, if you look at our stock market, exactly 12 months ago, the JSE Financials Index is up 24.6% in the past 12 months. The JSE Industrials Index is up 20%. Is that a bull market or a bear market, or what are we talking? Flattish?
You see, he starts throwing numbers at me. So you guys are going to have to defend your positions on this.
I'm happy to come in here. I mean, I think at the end of the day, South Africa has been in a bull market. One must recognize that.
Oh, my man.
South Africa. But we're talking more globally, and this question is, and I think Wayne pointed out, South Africa is not cheap anymore. So we've had a very good 10 years from a very oversold position then to a much more reasonable type of position now. And as long as economic activity remains strong and we can still export to someone, and interest rates seem to be under more downward pressure in South Africa probably than upward, or otherwise at least stable for a long period of time, maybe we can hold those type of gains. But against that, we have a global environment which is getting fraught, and ministers of finance and other people talk to that.
At the moment, the MSCI World Index, in strong dollar terms, by the way, is up 72% from its low in March 2009. The MSCI Emerging Market Index, in strong dollars, is up 95% from its low in March 2009. Is that a bull market or bear market or flatty?
No, I think we've had a wonderful run. The question is now looking forward and whether or not that is a rally within a longer term bear market. And markets have done nothing for 10 years. So you've picked a period of time when they've done something. Even this year, all the gains have been given back. So there is no return on major world markets this year. So I think we're in a bearish 20-year phase. We've had 10.
Well, I've got to get you in here. Wayne, I would say that you tend to side with Paul.
No, look, you've got to be so careful, as I said, about being too optimistic or too pessimistic. Generally speaking, I am optimistic because other than a couple of decades, and in the US we've just had a full decade, generally speaking, equity goes up over time because generally speaking, capitalism works. In other words, people
except
can
in Japan. Equities don't go up over time.
Yeah,
Well said.
but I'm just saying, you've got to be so cautious. You know, it's so investments is difficult, not because the subject matter itself is not understandable, it's that you're trying to predict the future. And even though I'm naturally a little bit more optimistic, you cannot at this juncture get optimistic about the world's economy. The most optimistic you can be, which is my view, is that we're not going to collapse. But that's about as optimistic as what you can be. And in that environment, maybe equity can do okay, but it all depends on the start valuation. And Paul mentioned interesting about banking shares. Banking shares were dirt cheap over a year ago, 2 years ago. I mean, these things were trading at 8, 9 PEs. Now they're 13, 14 PEs. So by and large, we've had the run. And Paul also correctly mentioned, now the big question is, Anglo-American and Billiton are trading at 7, 8 PEs. Are they simply from a start valuation point going to give us a decent return? But no matter how much, in my view, no matter how much you try, you cannot be overly optimistic about the world economy.
Glenn here, are we on the verge, in your opinion, of global financial crisis too?
I think we're in it. I think we're in the midst of it. I'm amazed that we even debate. It's a great question to ask, but I think the Japanese example you gave is very much, I mean, America plots almost exactly there. And again, we need to look at that long bond, which I think is such a telling feature, and it is kind of tracking what happened in Japan. So I think we can look at Japan's 22 years of going nowhere but down, and I think you have a very strong sense. And remember now, we're talking equities. There's a lot of asset classes which are financially repressed, as I like to say. I mean, there's no yield in cash and there's no yield in bonds. And the only debate we have now are equities because they're the maybe they can sort us out. But in any type of balanced portfolios, returns are going to be lower.
And that's why you've had 170 policy easings around the world in the last 6 months. With the cutting of interest rates lately from Australia, Brazil,
But the point was
India.
made earlier that policy easing is making no difference.
Watch, China is just beginning to start its engine. They are spending, they're cutting, and that's why I suspect you're probably seeing the low in resource shares right now. Not only that, but the US, as we sit right now, at least for the second quarter, is growing at about 2.5%, which is, for the biggest economy in the world, it's not that bad.
But are we going to see a reversal of fortunes in the US? Because that's a debate point at the moment.
All of this is around debt. All of this financial crisis, there is too much debt in the system. And that was Japan's downfall. They had the massive, unbelievable property boom in the 80s. They built up huge debt and they've never recovered from it. And debt is something you work through over decades. So there's too much debt. The one shining light that Paul mentioned was China hasn't got this debt. So China has the ability, essentially, the Chinese consumer will be the growth engine over the next 20, 30 years. Same as you can argue the American consumer or the European consumer, as they picked up debt, were the growth engine in the last 50 years.
Do we know enough about China to say that the Chinese consumer is going to save the world? Do we know enough about China?
Well, there are certainly a lot of unknowns, no question about it. And maybe
there's a high level of municipal debt. That's also been tabled over and over again.
But as we've said, that $3 trillion of foreign exchange reserves may be enough to sort that out.
Do you believe that the Chinese consumer is going to be the savior for the next 20, 30 years?
I need to be very cautious in what I say. I think Chinese expectations of growth at 10 have already been slashed to 7.5, and I think we slashed that by half again, and you get a much more realistic number for the next 10 years, but that growth is more likely to come from the consumer than it is from government or construction or building or exports, whatever, which are going to be obviously harder put. We just returned, and I think I spoke at the last meeting from the CFA conference, some good speakers on China, talking to some very major shake-ups taking within the political environment, taking place within the economy, etc. So I think we're going to see much slower growth out of China. So I'm not sure it will be robust, but to the extent it's growth, it's from the Chinese consumer.
But slower growth, how is the market going to react to that if you put it alongside all the negative news flow out of the US and out of the Eurozone?
You mean 7% on last year's growth?
Glenn's just made the point that we could halve that. Is that correct?
7.5% lower. Over the next 5 to 10 years, you would be much likely to see.
How will the market react to 4% growth out of China?
What, 3 years' time? That's okay in 3 years' time. This year, it would react quite badly. But, it's still
really,
growth
it would react quite badly? You don't think it would be the end of the world? I mean, come on, 4% growth out of China, the end of the world would be here.
You can't suppress Mr. Hansen.
It's the second biggest economy in the world.
So you'll get your head around 4% growth 3 years out. That'll be okay.
Look, by and large, I wouldn't be surprised if, maybe not 4%, but if lower growth is already in commodity share prices. These things are very, very low at the moment. But of course, that doesn't matter if China collapses on you. But if China sustains some sort of reasonable growth rate, whether that's 5 or 6%, probably do better out of the resource shares than what you're going to do out of other shares. But it doesn't mean the overall market goes anywhere.
Sell your island and buy some resource shares.
Let's not talk about property on this news desk.
So
right.
I'll just come back to two things that Wayne said I think is important. First one, just in terms of debt, because I think debt is the issue at the end of the day. For every $1.3 that America spends, it gets $1 benefit. So we have a negative efficacy of debt. It's really problematic. They're spending money. Put your finger down, Paul.
The audience can't see that. Paul's like a school child here.
You just won't stop. And the second thing I would say, and our managers are confirming this, is also what Wayne said. If there is a cheap part of the market, South Africa in particular, it's definitely the resource part. So these things have been hard hit. They've gone nowhere for a number of years, whatever. In fact, they've been down for a period of time. So if there is value to be found, it's more likely there.
Yes, Mr.
Countries
Hansen.
are in debt, not companies. Companies are in the strongest financial condition in moons. They are sitting on 560 billion rand of cash in South Africa.
That's a fair point to come back to right after this break. Well, let's come back to that. Let's head into a short break. More bulls and bears right after this.